Welcome to the Pro Ticker Deep Dive. We are jumping straight into what feels like the central tension dominating Wall Street right now. It's this great battle, really, between safety and growth.
Absolutely. For months, investors just piled into defensive stocks. We're talking utilities, consumer staples, healthcare giants.
Yeah, the usual suspects, believing they were the safe harbor, against all this economic uncertainty.
Right. But the big question now, the one everyone's asking, is whether these steady sleep-at-night sectors are about to give back those huge gains. Are they finally going to correct?
That's the fear, isn't it? That's what the headlines are shouting.
It is. But, when we actually dig into the numbers, cut through the noise, and look at the performance data, the story, well, it's a lot more complex.
Okay.
Yeah, our deep dive shows it's absolutely not some uniform correction waiting in the wings. What we're seeing is actually a very selective repricing.
Selective repricing, meaning
Meaning microfactors, specific company issues, and even big structural shifts are completely fracturing that defensive complex. It's not one group anymore.
Okay, so that's our mission today then. Let's unpack that divergence. We need to figure out why some of these supposedly safe stocks have just, soared, while others have completely tanked.
Exactly. We'll look at the pressure from interest rates that constant competition for yield plays.
And you mentioned a structural tailwind, something new.
Yeah, a surprising one. A sort of technological giant, you could say, that's fundamentally redefining and frankly propping up one specific defensive sector, setting it totally apart.
Interesting. Okay, so let's start with the setup, this paradox of safety. Why did they rally so hard in the first place, late last year, early this year?
Well, the initial rally was huge, right? And the rationale was pretty textbook risk aversion, but it was amplified by bond market speculation.
Oh, so.
You had lingering economic uncertainty, those ongoing tariff concerns. But the critical piece was the market being absolutely convinced the Fed would start cutting rates aggressively in the first half of 2025.
Right. Everyone thought cuts were coming.
Everyone. So defensive stocks were immediately treated as bond proxies, basically income-generating substitutes for bonds. If bond yields are falling, those stable equity dividends look really, really attractive.
That makes sense. Pure flight to stability, investors paying a premium for predictability.
Paying a huge premium, yeah. But here's where the surprise comes in. Hidden in the year-to-date performance for 2025. The broader market, the S&P 500, it's charged ahead up, 16.8%?
Aggressive run, yeah.
But the defensive complex, it's completely fractured, split wide open.
Okay, give us the numbers. How bad is the divergence?
It's pretty shocking. Look at utilities. They've absolutely soared, up a staggering 17.6% year-to-date.
Wait, hang on. 17.6%. That's outperforming the S&P 500.
It is.
How does a supposedly low-growth, safe sector do that? That kind of blows up the traditional playbook.
That's the anomaly, right? We'll definitely get back to that. But first, let's look at the others. Healthcare is up. Okay, 9.5%. Respectable, technically healthy.
But still lagging the market quite a bit.
Significantly underperforming the overall rally, yeah. And then you hit consumer staples. Your food, your beverages, household goods.
The real defensive bedrock usually.
Absolutely. They've actually slipped into negative territory for the year. Down 1.2%.
Wow. Minus 1.2%.
That one number tells you almost everything you need to know. This is not a unified defensive play anymore. Not at all.
So the core problem here, and this sounds like where the real risk is concentrated, is valuation compression, especially in those high-flying utilities.
Exactly. We're talking utilities now trading at a really premium multiple, around 22 times forward earnings.
22 times for utilities.
Yeah, and what are you getting for accepting that high multiple? Dividend yields of only about 2.5%.
Okay, let's compare that. The 10-year Treasury yield is sitting where now? Around 4%.
Around 4%, yes. So that 2.5% dividend yield from utilities offers a minimal, maybe even inadequate margin of safety over a risk-free government bond.
Minimal is putting it mildly. You're accepting all the volatility of the stock market for what? Less than 1.5% extra income?
Barely 150 basis points. And think about history here. Traditionally, periods of defensive strength, you saw yield spreads closer to 200, maybe 250 basis points over treasuries.
Right. You were actually paid a decent premium for taking on equity risk.
You were paid substantially more. Today, it feels like you're paying for the narrative of stability, not actually being compensated by stability itself.
That sounds like the risk-reward calculation is just completely upside down.
It feels like it. That minimal spread is kind of the alarm bell ringing. And that brings us neatly to the changing macro picture.
Right, because the fundamental reason for paying that premium, it seems to be dissolving, doesn't it? These stocks were priced for a really deep, nasty recession that, well, based on the data we're seeing, might not fully show up.
Precisely. Inflation has moderated, which is helpful. But the labor markets have been surprisingly resilient, still churning out solid job numbers.
Yeah, stronger than expected.
And maybe more importantly for investors, corporate earnings outside of defensives, particularly in cyclicals and tech, they've held up much better than the bears predicted.
So if the economy isn't actually falling apart,
Then the justification for paying 22 times earnings for a utility stock starts to look pretty thin pretty quickly. It erodes fast.
which makes that interest rate competition even more dangerous. We've got the 10-year Treasury at 4%, competing directly against this collective defensive yield of, what, 2.7%?
Yeah, about 2.7% across the board. That 130 basis point spread is fragile. The moment rates tick even slightly higher, that whole safety trade looks massively exposed.
Okay, but you mentioned an anomaly. Utilities. Is there something else going on there besides just rates and recession fears?
Right. We have to talk about the elephant in the room for utilities, AI-driven power demand.
Ah, the AI factor.
This is the structural reason, I think, why the utility sector is diverging so violently from staples and even healthcare.
It's kind of amazing, isn't it?
Yeah.
Utilities are the absolute definition of a safe, almost boring sector, are now caught up in the biggest tech speculation wave out there. How real is this transformation?
Well, what's fascinating is that it seems to be a genuine structural tailwind. It's actually moving utilities out of that purely defensive, rate-sensitive box
Into a growth story.
and into a legitimate growth story.
Bro.
Data centers need immense amounts of power, 2047. And you've got several key utility companies guiding for pretty aggressive load growth, like 8% through 2028, based explicitly on this AI demand.
Okay, so that huge 17.6% surge in utilities and that sky-high 22x valuation.
Yeah.
It's supported by a mix of two totally different things. Fear-based flight to safety plus tech growth speculation.
It's a strange cocktail, isn't it? And that's exactly why it feels fundamentally unstable.
Yeah, because those two drivers almost contradict each other.
They do. It makes the utility sector look completely different from the rest of the defensive pack, but it also means the risk is enormous because, half of that story is pretty speculative.
Which brings us right to this tale of two defensive sectors. It really shows how fractured things are.
Yeah.
Let's start with consumer staples. You said the pain, the correction, might have already happened there.
It really looks like it. Consumer staples got hit by a perfect storm of headwinds. First, margin compression was brutal. They got hammered by lingering inflation, rising cost of goods.
And they couldn't just pass it all on, could they?
Very limited pricing power. Consumers are just fiercely sensitive to grocery and household good price hikes right now.
We definitely saw people voting with their wallets, shifting hard towards cheaper private label brands, store brands, generics,
Yeah.
instead of paying up for the big names like Kellogg's or Tide.
Absolutely, and the company results showed it. You had weak guidance coming from major players, P&G, Pepsi. That signals to the market that these giants were struggling to maintain margins.
Undermining their core appeal as stable profit machines.
Exactly. That's the bedrock of the staples investment case, usually.
So the fact that they're down 1.2% for the year while the S&P is roaring ahead almost 17%, that suggests serious selling pressure. What about the technicals? What are charts telling us?
Well, the main consumer staples ETF, XLP, it's sitting at about an 8.2% drawdown from its peak earlier this year. And here's the key signal. It has broken decisively below its 200-day moving average.
Okay, and for chart watchers, that means?
For technical traders, that signals a genuine, established downtrend is likely in place. It suggests the safe money crowd has really capitulated and gotten out of the sector. The selling might be mostly done.
Okay, so staples corrected. Meanwhile, utilities are, as you said, pricing for perfection. Their huge outperformance driven by giants like NextEra, Southern Company, Duke, all riding that AI waves and regulated rate-based growth.
But we have to stress the risk again. That sector's 22.1x forward PE, it's a multi-year peak. And it depends entirely on some aggressive, maybe even contradictory assumptions holding true.
Like what?
Well, they need sustained commodity inflation to justify rate increases to regulators. They need that high AI load growth, which is, let's be honest, partly speculative, to actually materialize. And crucially, they need stable regulation that lets them pass on the huge costs of building out infrastructure to consumers.
So if just one of those pieces falters.
There's significant execution risk. The premium valuation could evaporate very quickly.
And then stuck in the middle, we have healthcare. A 9.5% gain sounds okay on its own, but compared to the market, it's underwhelming. What's holding it back? Why isn't it getting that safety bid?
It's in a weird spot. Technically, the sector looks healthy. It stayed above its key moving averages, but it lacks the excitement of the utility AI story, and it hasn't had the big washout capitulation we saw in staples.
Just there.
Kind of just there. And it's facing two really persistent headwinds. One is the constant political noise around drug pricing that never really goes away. The other is growing concern over patent cliffs for several blockbuster drugs.
Meaning big revenue sources are about to face generic competition.
Exactly. So it just doesn't offer that pure, guaranteed safety investors seems to be fleeing to right now, nor does it have the speculative growth angle it's caught.
Okay, let's pivot then to risk and opportunity looking forward. What specific things would bearish catalysts could trigger that sharp correction we talked about in the high flyers, like utilities? You mentioned maybe 15–20% downside if momentum breaks.
Yeah, the primary risk is still interest rates. And there's probably a specific level to watch. If we get stronger than expected inflation, forcing the Fed to keep rates higher for even longer,
That compresses those utility yield spreads immediately.
instantly makes them look uncompetitive compared to safer treasuries. That's probably risk number one.
And what about the AI story itself?
That's risk number two. If the big capital expenditure plans disappoint, maybe data center construction slows down, or those electricity load estimates get revised lower, that just crushes the growth narrative, propping up those high utility multiples. Huge valuation risk there.
Makes sense. What else?
Well, just a broad economic reacceleration could do it too. If cyclical and growth stocks really take the undisputed lead, if that no recession story truly solidifies.
Capital just rotates aggressively out of defensives and back into growth.
Right. And crucially, keep an eye on the 10-year Treasury yield. I think a sustained move up towards, say, 4.5% would likely be the inflection point. That could be what shifts momentum and capital decisively away from defensives.
Okay, so given this whole complex picture, this divergence, just buying the whole sector broad allocation, it clearly doesn't work anymore.
No, that strategy is broken right now.
So active security selection, picking individual stocks, becomes absolutely necessary. Where might the smart money be looking, or where should investors maybe focus?
Precisely. Let's revisit consumer staples, but maybe with a contrarian hat on.
Okay.
They're genuinely looking cheap relative to their own history now that the fear-driven money seems to have left. They've already had their correction, arguably. Companies showing strong operational results even in this tough environment, think Costco, maybe Walmart, they're showing resilience.
So potentially an entry point for long-term value investors who want actual safety, but at a reasonable price this time.
Potentially, yes. The crowd has abandoned them, which is often when value opportunities appear.
And what about income seekers worried about those fragile yield spreads elsewhere?
There, I think the focus has to shift towards quality, real quality. Looking at the dividend aristocrats, companies with 25-plus years of consecutive dividend increases.
Proven track records.
Exactly. They offer a historical buffer against volatility. And you can find many of those names trading at, modest discounts to their recent highs. That offers real dividend quality, not just yield based on speculative growth or compressed valuations.
Okay, so let's try and synthesize this whole deep dive, the big correction that everyone's talking about.
Yeah.
It isn't necessarily a straight line down across all defensive stocks.
Not at all. It's really a correction in investor expectations and their positioning. We're seeing a rapid shift away from owning defensives just out of generalized fear.
Like hiding under the bed.
Kind of, and moving towards owning defensives that actually have reasonable valuations. And, this is key, a genuine quantifiable growth catalyst behind them. Or at least understandable stability.
It feels like the whole pandemic era created this artificial peak in defensive valuations, just because fear drove everyone towards anything perceived as safe, regardless of price.
I think that's right. An extreme driven by fear.
So navigating the reversion, the return from that extreme, requires a totally different strategy now. You have to move away from passive sector allocation, just buying the XLU or XLP ETF.
Yeah, that's probably not enough anymore.
And towards really active security selection, digging into individual companies.
Absolutely. Individual company choices, understanding their specific fundamental drivers or headwinds, whether it's AI demand estimates for a utility or consumer shifts to private label impacting a staple that matters far more now than just picking the broad category.
That seems like the most powerful lesson from this stark divergence we've seen this year. Stock picking is back, even in the safe parts of the market.
It really is. The details matter more than ever.
See you all in the next Pro Ticker Deep Dive.